Welcome to the Business Resilience Decoded podcast, brought to you by Asfalis Advisors and the Disaster Recovery Journal. Crisis management in today's world is ever-changing, and this podcast is our commitment to help you navigate successful outcomes for any crisis you may face. I'm your host, Vanessa Matthews. I specialize in providing insights and solutions for crisis, continuity, and resilience across industries from real estate and healthcare to terrorism in the airline and transportation worlds. No matter what industry you're in, this podcast will provide you the tools to build resilience in your organization. Welcome back to another episode for the Business Resilience Decoded podcast. Today, I'm super excited. Our podcast title is What We Can Learn from the Silicon Bank Failure in Leadership and Risk Management. Our special guest today is Chris Holmes. He is the CEO and co-founder of RiskVersity. Chris, welcome to the podcast.
Thank you very much for the invitation. Happy to be here.
I'm super excited. It's our first time interviewing somebody from the RiskVersity team. We met a few years back, and so I'm very excited for this topic and to have you on. To give a little bit of background on what we're going to talk about today before we dive into our content, with over 15 years of experience in risk management, Chris not only leads RiskVersity, but he also sits on several business and advisory boards. So we're super excited to dive into today's content. So let's start by talking, Chris, what happened with the Silicon Bank failure and what ramifications have been made to those organizations that were a part of that?
Let me start by saying that it's a very complicated, well, not complicated, it's a complex set of circumstances. And folks who want to get a lot more details can review the Federal Deposit Insurance Commission's report on this entire event, which goes into a lot of specifics. But in general, what happened with SVB is as a result of, so banks have liquidity requirements, right? A part of those liquidity requirements say that they have to have a certain amount of cash on hand in order to be able to give out to depositors if there's a demand made on the cash that they've had. But for the rest of those funds that don't fall underneath those liquidity requirements, they can invest those funds into certain assets. One of those asset classes that SVB decided to invest in was treasury bonds, which is a nice, safe investment for most of the time. However, whenever you have volatile events like interest rates going from 1% to 5% to now almost 7% over the span of just a few months, it makes the value of those bonds fluctuate. So that, in tandem with folks making withdrawals from the bank, which increased the bank's liquidity requirements, meaning that they had to liquidate some of the assets they had invested inside of those bonds in short order, caused the bank to essentially experience a cycle of a liquidity need, selling assets, liquidity need, and then selling assets to the point where the bank was actually failed and went into receivership with the Federal Reserve.
And this, of course, in my opinion, starts with leadership and risk, right? Because somebody probably wasn't paying attention to something. But can you talk a little bit about how you've seen this ripple effect within the RiskVersity portfolio?
Sure. So the major banking needs of our company, for example, are done with what are called systemically important banks, or SIBs. These are the too big to fail banks. However, what we've seen from some of our clients who are investing more with regional banks, they're having some challenges still today because of this particular event. So whenever SVB failed, folks who were banking with SVB and other organizations took a look around and said, hey, if this could happen to regional bank X like SVB or some of the other banks that had a similar challenge, it probably could happen to mine as well. So there was a flight, if you will, to safety, meaning that cash kind of flew out of those local regional banks and are now going into these systemically important banks. So for our clients, what we're starting to see is that same flight, if you will, to safety as a part of their risk management strategy, is to take those funds from those regional banks who have that liquidity challenge to some of these systemically important banks. One of the things that the Federal Reserve has done in order to kind of cull that or to soothe investors or depositors' concerns is to increase the insurance limit that they have on funds. So traditionally, the FDIC would insure funds for deposits up to $250,000. That number has now been lifted for regional banks, so they essentially don't have this challenge but the risk still exists inside of the minds of the individuals who are depositors at those banks.
Yeah. So here's what concerns me about that. Like there's a
Mm-hmm.
ripple effect that if
Mm-hmm.
this trend continues and it impacts local and regional banks, that's my first concern. But the second concern that I have is from my experience, and you tell me because I could be, totally wrong here. Typically, it's the big banks that are not in compliance that we're always bailing out. So why would anybody pull out funding or dollars from a regional bank or a credit union, even
Mm-hmm.
if the insurance is not as high as a larger bank? They typically are the ones that actually follow the rules.
So I would agree with you in most cases, at least from the perception point of what we have. So in 08, 09, a lot of us saw larger banks and organizations begin to fail and be bailed out by the federal government, right? So that precedent, right or wrong, is what folks are looking at today. So whenever you look at a bank like a JP Morgan Chase or Wells Fargo or someone of that caliber, we, right or wrong, understand that those banks are, quote, too big to fail. So if there was a challenge, it would pose a systemic risk, and we know that the federal government, the Federal Reserve, would step in and essentially rescue those banks. That safety net doesn't necessarily exist for some of the local regional banks, which may be in compliance or may not be in compliance. So because of that fear or that concern, we know, once again, right or wrong, that those larger banks are going to get the bailout and not necessarily the regional banks. Then folks are making that flight to safety. So that's some of the ripple effect is that we're moving from the regional banks, who are the ones who lend to smaller businesses. They are the ones who lend to folks who are doing real estate transactions, typically commercial real estate transactions specifically. I want to say 60 or 70% of the real estate holdings in the U.S. are done by these small regional banks. So as money leaves these institutions, there's fewer resources for our local communities to continue to invest inside of their real estate infrastructure, the small businesses, et cetera. So those are some of the ripple effects. But I don't know if I'm exactly getting to the answer to your question.
Oh, that was phenomenal, Chris. Yes.
Okay.
So what I appreciate about us having a risk management background is there's two things that I really love, and that's root cause and then what's the consequences, right? And so when we talk about risks and understanding kind of that landscape that you just laid out for us, what are we now more susceptible to due to the Silicon Valley Bank failure as individuals and as business owners or leaders? And then how do we prepare for those risks?
Sure. So I think one of the things, and I alluded to it a moment ago, that we're going to be very challenged with is inside the commercial real estate market. So when I say commercial real estate, I don't want you to think about huge office buildings, even though those do apply. I want you to think about 40 to 50 unit apartment complexes that may be inside of your neighborhood, some of the strip malls that may be inside of a local community. Things of that scale are impacted inside of commercial real estate as well. As we continue to have these funding challenges, a number of those loans, typically your mortgage, for example, is on a 30-year fixed rate. That's not how commercial real estate typically works. Typically, they're on a 5 or 10-year arm. So what that means is that those folks are coming up for renewal on their loans within inside of that window when we have interest rates that have gone up, in some cases 5-fold. So the local strip mall owner or apartment complex owner, and even some of the larger commercial properties are going to be facing sometimes 1.5 to double what their mortgage payments were coming up, let's say in June to July. Now, rents have only gone up about 33% over the last, 5 or 6 years. So whenever we look at something like, rents going up 33%, but your mortgage payments going from 1.5 times to double, it's going to be a serious problem for the real estate market if this trend continues with interest rates rising and the liquidity not necessarily being there. So that's from a business standpoint for some of the folks that we're looking at and having that conversation with. Individually, what we're looking at, or what the Federal Reserve has done so far, is to stop that systemic flow of cash out of these smaller banks into larger banks, which in theory should stop some of these failures from happening. But if they don't, if these fears are not called, then we could have a systemic banking failure like we did. We'll go on the cusp of inside of 08, 09.
I have so many more questions.
Please, I'll do my best.
Look, you just took me to school. Okay, so on the personal and business side, last question, because I really want to talk more about RiskVersity. Can you share a little bit about what are the leading indicators that we can start to pay attention to so that we can know it when we see it and start to be aware?
What the Federal Reserve has done now is they put out some reports on bank balances, essentially. So I want to say it's quarterly. It might even be monthly for these numbers. And so two numbers to pay attention to, just as very simple, like you would do inside of your household income, would be, what are my current assets and what are my liabilities? If we start to see the asset lines of these banks continue to decline and those liabilities continue to increase while the investments are being downgraded and reduced as well, that's a leading indicator that there could be a challenge with that specific institution. For us, for me, for you, the average person that doesn't have, and I'm sorry, I'm assuming, I'm making a gross assumption, the average person that doesn't have more than $250,000 inside of a single bank account, it's a non-issue. But for some of the businesses that we run, like Asfalis and RiskVersity, where those assets can get up on a monthly basis, up and above that number before payroll hits, so to speak, then we may want to look at doing something different with the cash that we have on hand, either moving those funds, like a lot of folks have already done, to the larger institutions, or if it's an easier solution, it can be cumbersome spreading those funds out so that you're below that 250 mark inside of multiple institutions.
Makes sense. Okay, so switching gears to leadership and the founding of RiskVersity, can you tell us a little bit about your background in entrepreneurship and risk management, and also specifically to what led you to start a company?
Unlike a lot of folks inside of the industry, many people kind of stumble into the industry. I did to a degree. So my background's in actuarial mathematics. I minored in risk management and insurance inside of college. But the way that I got here was because I was very good at computer programming, but I hated it. And that's nothing against programmers. It's just that for me, it was not the thing that was, getting me out of bed every night. So I went to my advisors, talked to some of my mentors and said, hey, how can I use what I currently have, which was a bunch of math credits, and not fall behind in my graduation schedule and still, do something that I might enjoy. So they recommended that I keep those math credits and major in actuarial mathematics. I had no idea what that was, what was at the time. But as we got closer to internships and graduation, I found out what an actuary was and decided that's not for me either. So I did an internship with an organization called Arthur J. Gallagher, which is a risk management insurance brokerage, transitioned over to Wells Fargo Insurance Services, doing the same thing, selling commercial property and casualty insurance. And it was at that point, Vanessa, that I started looking around at people who were 20 and 30 years my senior, and they were doing the same thing that I was doing. And I asked an important question to myself, is this what I want to be doing for the next 20 or 30 years? For anybody who's starting a business or is currently going through their time inside of corporate America, I would advise that they ask that same question. Is this something that I want to do for the next 20 or 30 years? And the answer for me was a resounding no. So I went to my management team, had a conversation, and they were kind enough actually to offer me some time to think about it. Paid. I took that opportunity to think about it, and at the end of that time frame, I actually left the organization. So what motivated me behind the scenes during that time was myself and four other my four business partners inside of my first entrepreneurship venture which was legacy investment funds. We were talking amongst ourselves about, Black wealth and opportunities for growth inside of the investment space. So we pooled our money together so that we could buy and sell real estate, and that organization still exists now. So that was sort of the genesis, if you will, for that initial journey. I feel like there was a part B to that question, Vanessa, and I'm sorry that I lost it.
No, it's all good. I think you answered it in terms of what led you to start, especially with the risk management focus, but you've had legacy investments was already a part of your entrepreneurial journey before you got into RiskVersity. So
correct.
To add on to that question, to get more insight, as the CEO and co-founder of RiskVersity, what do you think are the most important leadership skills for managing a company and its team?
Yes, ma'am. So let me conclude that story just to include the RiskVersity piece in there real quick, and I'll answer that second question, which is that one of my partners said, hey, you got this great background of risk management and insurance, we should be using that. So Lawrence, who you've met before, talked me into getting off of the sidelines, so to speak, and using that portion of my my background. So in 2015 we started we started RiskVersity at that time, and transitioned it into what it is now, which is a consulting firm, enterprise risk management consulting. So to answer the second part of that question, thank you for giving me the leeway to back up. what I think is very important for leading inside of a company or an organization is empathetic listening. Empathetic listening. So, today, as you know, employees have a number of options in which they can be employed or work for. So if we're not, as leaders, listening to the needs of the folks who are inside of our organization and saying, hey, what can we do to make sure that you feel like this is a place that you can grow, thrive, and develop in? And some folks know and understand what that is, but other folks need some coaching or some pulling, if you will, in order to get that to come out of them. And I think that empathetic listening is a good skill to learn and develop as a leader in order to pull those things out so that folks feel safe and engaged at a workplace.
Yeah. Last two questions for you. Mm-hmm. I've had the pleasure of having a partnership with RiskVersity and CyberSure. And so as you kind of think about where you are now and what's next, can you talk us through what is next from a business perspective?
A couple of exciting things are happening for us now, Vanessa. One, we've had a lot of success internationally over the last, I'd say, 6 to 9 months. We had an excellent new hire when we brought Paul Marchina onto the team about 18 months ago, and he has just been doing a great job at getting us into some of our international clients now. So we're excited about some of the growth that's happening inside of that area, specifically because in the Dutch Caribbean, for example, there's some laws that are being passed that are forcing organizations like banks, like SVB and other financial institutions to look at their enterprise risk management program. So it's a natural fit for us to kind of dovetail with those new requirements and fit into that seam in order to solve a challenge that currently exists inside of that marketplace. So that's one piece. I think the second piece is we're part of several minority business accelerators. And one of those is out of Cincinnati, Ohio. And now Lawrence and myself are inside of a program that's in partnership with Rutgers University that's really helping us take our business to the next level. So it's doing an excellent job of helping us work on the business and not necessarily in the business all the time. And I think if I could go back in time, that would be something that we would have done much earlier inside of our business, is develop a plan to work on the business and not always in the business on the day-to-day.
Yeah, man. And you have to have capacity to be on and not in.
Yes, ma'am. Yeah, certainly.
I love it. Well, short shout out to Kevin Dick for making the introduction to Asfalis Advisors and RiskVersity. When we think about the space of risk management, cybersecurity, emergency management, crisis management, insurance, you typically don't see folks who look like myself and Chris. And so it has been very important for us to be intentional about where we partner and how we partner. And I've definitely appreciated the thought leadership and the partnership from you and Lawrence. Lawrence is a hoot for those of you who have not had the chance. But last question for you, where can people find you and connect with you after this episode?
Sure. So we're on the traditional platforms, LinkedIn, Twitter, Facebook. We are growing as an organization to reach out and be more on platforms like Instagram and some others. But we recently did, Vanessa, a video series on everyday risk management. And our aim is just to translate risk management practices and principles into something that people can use on an everyday basis. So if they were to go on LinkedIn, Facebook, or Twitter and find RiskVersity, they could be able to engage with some of that content. The most fun was whenever we did stunt car driving experience at the BMW School of Driving and parlay that into risk management practices. Is really neat, and folks should check it out.
Well, that is funny because every decision is literally a risk decision.
Mm-hmm. Mm-hmm.
Awesome. Well, thank you for tuning into the podcast, and you all have a wonderful week. Thank you for listening to the Business Resilience Decoded podcast, brought to you by Asfalis Advisors and Disaster Recovery Journal. Make sure you check out the show notes for this episode to see all the upcoming events, programs, and ways we can support you. Make sure you subscribe to the show wherever you get your podcasts, leave us a review, and share it with a friend. Thanks again, and I'll talk to you in the next episode.